Hello, I'm Spencer Hall, and I hope that you're having a great springtime. I want to bring you an update on what's been going on in the stock and bond market here of late, the first part of this year. And really want to phrase this in two ways. First, we'll talk about what's happened, and second, I want us to talk about the mental approach that we take to process what's happened. So in thinking about what's happened first, you would have to be living under a rock not to have seen that stocks and bonds have both taken it on the chin this year. The stock market, as I speak, is down almost 20%. Stocks are the growth engine long term in most clients' portfolios, but they tend to be volatile. If we think about that average volatility, if you look back to 1980, the stock market in an average year from its peak to trough will drop about 14%. Now, we've gone above and beyond that a little bit. Another stat that I would cite would be going back to 1950, about 1 in every 5 years, we have a drop where we go into what would be called a bear market, where we're down 20% or more. And we may go into that this year. Now, we also might have a recession later on this year. Economists are kind of split, whether we may hit that in late this year or next year, or may not even have a recession. But what we can see is that companies continue to make money. U.S. stocks as a whole are projected to make more money this year than they ever have in the past, and analysts and the stock market, the stock guidance from companies is such that 2023 is supposed to be better than this year, and 2024 even better than 2023. So companies remain solidly profitable even though prices have dropped. So all of that comes together as we think about stocks. Now, flipping over to the other side, the bond market. Bonds have dropped this year, and usually bonds are slow and steady as she goes. They give us a rate of return but don't introduce the same ups and downs that the stock market does. Now, one statistic that I would cite is that since 1950, the U.S. bond market as a whole hasn't been down more than 8% in one calendar year. This year we're already down about 9.5% as I speak. Earlier this week we were down more than 10% at one point. So if the U.S. bond market, if interest rates don't change much until the end of the year, what we'll find is that we'll be right at that 8% drop or so by the end of the year. If we put this in further context, the U.S. Treasury bond market has really gone up in terms of its interest rates or the yield to maturity significantly as well. The 2-year U.S. Treasury has almost quadrupled from 0.7% up to 2.6%, and the 10-year U.S. Treasury bond has almost doubled from 1.5 to 2.9%. So despite the challenges that we face in the bond market, it does mean that better returns are probably ahead of us because, again, those yields to maturity and interest rates are higher going forward. So that's what we've seen. If we think about the way that we process that information, probably even more important than what the results have been. And I want to walk through 3 basic thoughts about how we process that information. This next part, I want to show you a slide that comes from J.P. Morgan and Dalbar. But the idea is that we're really our own worst enemy. Dalbar has researched how people invest funds and make changes over time, and their conclusion is that most investors are bad at market timing, but they try to do it anyway. Getting into the specifics, Dalbar approximates the return achieved by the, quote, average investor over a 20-year period relative to an index return. Despite strong index returns over that time, the average investor has garnered less than half of the return of the index, or missing about 3.5% of what the index would have given them if they just stayed the course. So it's really, really important to have our mind in the right place. The second part that I want to highlight is that timing the market is really difficult, and mistiming the market has some important consequences that we need to consider. Now, Americans, just like the children of Lake Wobegon, tend to believe that they're better than the average investor. If you're one that thinks that you might be able to time the market better than the average person, I just want you to consider these risks. The chart illustrates the results of missing the 10 single best days in the market over the last 20 years. Now, if you think that that's unlikely, consider that the majority of the best 10 days happened within a couple of weeks of the worst 10 days. Since we've had some big drops recently, history would suggest that brighter days might be right around the corner, and it might be best just to sit on our hands and stay the course. Third thing I want to highlight as we think about our mental process is that there's always a reason to be worried. There's always a reason that we could choose not to invest. In 2020, investors were concerned obviously about COVID, about the presidential election. In 2021, it was a new variant of COVID. It was what was going on in China with the regulatory environment, the real estate environment. This year, of course, it's been inflation, it's been increased interest rates, it's been the conflict in Ukraine. There's always a reason. But if we think back over history, as you look at this chart there, we could go back the last 20 years, or I would argue we could go back the last 100 years, and there's always been a reason that we could be concerned. Yet, if we look at this chart, since 2017, the U.S. stock market has almost doubled since the beginning of 2017, again, even with the most recent downturn, if we just stayed the course. I hope these elements of reviewing what's happened and also how we might think best about what's happened has been helpful. As always, it's our mission to bring confidence and rest to your financial life. If you have any questions, don't hesitate to reach out to us. Thank you.
We hope that you enjoyed this video presented by Retirement Planning Services. We are in Knoxville, Tennessee, and you can find us at www.seriousretirement.com. Our mission is to bring confidence and rest to your financial life so you can focus on the people, causes, and activities that give you energy and life. Advisory services are offered through Retirement Planning Services, LLC. All examples are hypothetical and for illustrative purposes only. Actual results will vary. No part of this presentation is intended to make an offer of sale or purchase of any specific security or insurance product, nor to offer accounting, tax, nor legal advice. Past performance does not indicate future results. Indices are unmanaged and cannot be invested into directly. Thanks for watching, and we hope you have a great day.